Well, I think we're ready to get started for the deep dive this morning. So I want to say welcome to everybody joining. It's Monday, May 2nd. And if you saw the video, we're going to talk about, this topic of crash seems to be everywhere in the news and a lot of other places, and really give you everything you need to know to be the most educated agent on this topic. Let's get started. I'm going to share my screen so that we can always look at the visuals. I mentioned the blog that we wrote, why this housing market is not a bubble that's getting ready to pop. You may have seen this about a week and a half ago. We wrote this blog. A lot of agents have shared it, but use this if you want to get this content out into the market. Share that blog. If you're a KCM member, certainly share it in your Simplifying the Market website. But it starts to unpack where we're at right now in real estate. And, kind of the central theme is this graphic right here. And this is a look at home price appreciation going all the way back to World War II. Why is World War II important? It's important for this reason. That's really the start of the modern day housing boom. Think of all the GIs coming back from the war. GI Bill provided for them to go out and buy homes, and that really started the push in the housing market in this country, where today 2 out of 3 people own their homes. It's the American dream, and we certainly want to help more and more people own their home. And there's one time since World War II, you see it there in the middle, where homes lost significant value, and that was back in the housing crisis in 06, 07, and ultimately in 08. And that was caused for 2 reasons. First reason was loose lending standards that were out in the market. Think about that. Was commonly referred to as a ninja loan, no income, no job. You didn't have to verify any of your assets. You didn't have to verify your ability to earn income. And we know how that turned out. The second thing that caused that is during that time, many people cashed out the equity they had in their homes. They sort of used their homes back then as ATMs, going out buying jet skis, going on vacations, thinking this will never end. We don't have a problem here, and we know what happened. Ultimately, homes started to lose value. People owed more on the home than what it was worth. They were underwater and they walked. That caused the housing crisis on a grand scale. Back during that time, over 9 million homes went into some type of distressed sale, either foreclosure or deed in lieu, something, the short sale, something that happened there that was, a tragic event for those folks that went through it. And so I want to kind of take the approach of how is today different, give you the facts. I'm always encouraging to develop your market opinion based upon facts. And so we're going to go through that today. And really is this article that I was talking about that addresses home values since World War II. If you fast forward to today's real estate market, you have to qualify for a loan. And we know people aren't cashing out their equity on a massive scale. So I'm going to prove that as well. So all of that is what we're going to cover over the next few minutes. We've got a lot of people on. Feel free to share this as well with folks that are in the business. Maybe you've talked to somebody in your office about it. Share it with anybody that can be benefited from this information. So first point that I want to make in this question, is the real estate market going to crash or homes going to lose value, is this: no experts are calling for homes to lose value this year. This is the latest look of 7 forecasters, across the span from MBA to Fannie Mae, anywhere from 10.8% appreciation to 6% appreciation in the real estate market this year. The average of all 7 right now is at 9%. Now, if you remember this, we've talked about it from the beginning of the year. This was about 5.5% in January and started to ratchet up. And I said, they have sort of a bias to the upside. We're seeing them move their forecast up in home price appreciation. We think somewhere between 8 and 10% is where we'll end up in this year. And we're starting to see that. We're seeing that bias towards the upside in residential home price appreciation. But I want to be clear, that in itself is not a reason to say, homes aren't going to lose value, but it is something you have to look at and say, no experts are calling for that. Okay. So first point. The second point that I want to make here that people may ask is, well, what about all of those affected during COVID that couldn't make their mortgage payments, the foreclosures that could ensue outside of that? Let's take a look at that. We haven't talked about that in a long time. If you've been following the deep dive for the last couple of years, we talked about that on a regular basis, and we haven't talked about it in a while because it's become a non-issue. But the number of forbearances continues to edge downward, just under 700,000 mortgages in forbearance right now. That represents right about 1% of mortgages. At the height, we were almost 5% of mortgages in forbearance. So those are coming down. The question always comes is what's happening to those as they come out? These are the most recent numbers here of those coming out of forbearance. If you remember this graphic, it tells the story, as of March 31st, we'll get the April numbers here in the next couple of weeks, but 37% in that green shaded area were paid in full. Those are the ones that took it out maybe as an insurance policy and didn't need it. The area in the blue went through some kind of workout with their bank. For almost 45% of people engaged with their bank, said, hey, we're having trouble. They either went through a rate and term refinance or tacked it onto the back end. They went through a workout. And about 18% don't have a plan or are in some sort of deed in lieu short sale type of situation. So that's the look at everybody coming off right now. So the overwhelming majority, 4 out of 5 people that have come out of forbearance, have come out whole. And I'm not saying they won't have issues or they couldn't have issues. They certainly will, because that's a fact of our business. But this is not the story that many thought would happen to those that are coming out of forbearance. So that's one thing we want to look at. So experts are saying, hey, we're going to see appreciation this year. Don't see depreciation coming. We know it's not coming from these folks that have been in forbearance. And oh, by the way, if folks come out right now and they need to sell their home because they're in a challenging financial situation, they have equity to sell. If they were to be foreclosed on, those homes would be snapped up almost quicker than they could come to market in a multiple offer scenario. So that's the reality of where we sit right now. But I want to go back to what I said before. The original crisis in 2008 was caused by lending standards that were loose. There were standards in the mortgage business that had sort of deviated from what the past had been done, and they really thought they could bundle those up with alt A and A mortgages, really good credit mortgages with some bad credit mortgages, and it would be okay. And it didn't work out okay. But lending standards are nothing like what they were back then. And I always like this graphic. Take a picture of this graphic. If you want to share it, download this, use it. Lending standards are nothing like they were in the early 2000s. There are 2 components of lending standards you want to look at. First is product risk. So think about that, the type of product in the market. And remember, I said ninja loans back then, no income, no job, no verification. And then you have borrower risk. Think about that, the ability to repay, your credit score, your asset profile, all of those things. Well, product risk has been virtually eliminated in the mortgage business. Those products aren't around anymore. And borrower risk has been significantly curtailed. We talk about how the pendulum swung back and you had to qualify for a loan, and it got harder to go out and buy a home because lending standards had gotten that much more tough during the housing crisis because we didn't want to go back there. And that's the story of what happened in the mortgage business. And all of this, and I want to give you kind of the result of all of this, has given us a world and a real estate business where foreclosure activity is at an all-time low. Okay, we go back to the housing crisis, all of the red shaded area, over 9 million homes going into foreclosure. It gets a lot harder to go out and finance a home, to get a mortgage. The ability to repay is sort of enforced, and people have to put money down. They have to think about, okay, do we qualify for this mortgage? And it's driven foreclosures down. And you see, as we've gone through 2016, 2017 here in this graphic, 18, 19, into the last couple of years. Now, there's been a moratorium on foreclosures in the last couple of years. That's why we've gone significantly low, but the definite trend line is moving downward because it's gotten harder to qualify for a home loan. Okay, if we want further proof of that, lending standards have gotten tighter since a crash. This is a look at the number of loans given to someone with a credit score less than 620. Okay, back in the housing crisis, you could have a credit score that maybe wasn't where you needed to be, and you were able to qualify. Today, that is not the case. We're not giving the loans in volume like we were to those with a credit score less than 620. So all of this leading up to things are very different in the mortgage business, which again caused the last crisis. The other piece of information I think is very, very interesting in this, the percentage of adjustable rate mortgages are at a record low. If you remember back in the housing crisis, a lot of adjustable rate mortgages in the market, you see there in the red bars there, percent of all mortgages that were ARMs, adjustable rate mortgages, you see 34, 37, 33%, where today, fast forward, 1.7% of mortgages. Everybody's saying, hey, we don't want that. Now, I do believe you'll see more adjustable rate mortgages come into play as interest rates rise. And adjustable rate mortgages aren't a bad thing. There really are no bad financial products. There are misused financial products, but not bad ones. And so we don't have the scenario like we had in financing for homes like we did back then. Now, the next question that comes up, well, as inflation rises, as things get more expensive, people aren't going to be able to afford their homes. That is an objection that comes up in this. And I want to give you a little bit of, sort of background on that as well. A study from the Fed here that looks at household debt service ratio for mortgages. That's really a percentage. A mortgage is a percentage of disposable income, sits at 3.8% today. Back in 2007, that was 7.2%. If anything, we've seen that number slide since 2007. We are not even where we were in 1991. The percent of debt as compared to personal income is lower than it's been for quite some time, going all the way back to here, 1980. Okay, so it's not a debt servicing issue. And that's something that people like to bring up and like to talk about. Certainly not here. This is a report from the Fed. If you're a KCM member, you can always go into the notes of any of these slides, go to the source report and do all the reading you want to do on a topic like this. Last slide that I want to give you here before I take any questions, Jess, is cash out refinances. People saying, well, back then people cashed out all of their equity and they were left with nothing, prices fell and they walked. This is a look at the price difference, a difference in annual mortgage payment in cash out refinances. So you take the original payment minus the new payment and you get a difference there. Back in 2006, 7, and 8, it's shocking to see the difference in mortgage payments and cash out refinances. This is from a study from Freddie Mac. You can go to this link, go look at this study, go kind of do a deep dive into it if you want to. Well, the last couple of years in 2020 and 2021, $66 difference in the payment, $34 difference in the payment, and a cash out refinance. That speaks to a couple of things. One, people aren't leveraging the cash in their home and using it as ATMs like they did back then. Second, there was a term back then called equity harvesting. You remember that if you were in the business, people would reposition equity from their home, put it in the market, put it into something else. And that's certainly not happening today based on what we can see from this report from Freddie Mac. So a lot of reasons there that we do not see a crash coming in residential real estate. The facts do not support it. All this information, use this to get this out to the clients that you serve. Make a video with it. Use the blog that we posted on the 21st of April. If you missed the opportunity, I want to go back to the video masterclass. More than anything right now, we've got to be on video. And what we did at KCM is we went out and got the experts, Jason Pantana, Tom Ferry, Patricia Stark, Renee Rodriguez, all the experts on how you make great videos, and asked them to sort of record these vignettes for you to help you think through that. If you haven't gone and downloaded this, it's free. Go do it today. I'm sure Jess or somebody will put that in the comments of how to do that, but take advantage of this because it's going to go away. It's only going to be around for a short time, and you're going to want to take your team through this. You're going to want to go through it yourself so that you have the best information you can, not only to make the best videos, but to get the most out of those videos. So Jess, I'm going to pause for a second and see if we have any questions.
Sure, Dave, I did see just a couple of questions come through. The first one from Diana, who asked, if inflation continues to worsen, do you anticipate interest rates will come down by year end?
If inflation continues to worsen, do I anticipate interest rates will come down at the year end? Well, I would go back to what forecasters are saying. Forecasters are saying interest rates will continue to rise, but not at the pace over the last 4 months, let's call it. And why is that? Because there are three things really contributing to interest rates rising: inflation, the instability in the Ukraine and with Russia, and then what the Fed is doing to get inflation under control and essentially slow down the economy. I think what forecasters are saying is that will get taken care of. They will get inflation under control. Now, the question is, how long will that take? I think if inflation continues to rise, then we're going to have an issue there. But if they're able to get that under control in the next 3-6 months, I don't expect rates to rise at the pace they have for the last 4 months.
Awesome. Thank you for that, Dave. And I did see a couple of folks asking what might happen to prices if there's a recession.
Oh, it's a great question. I'll have to leave that one for you. I will tell you, we've got a great graphic here at KCM for that. And 4 of the last 6 recessions, prices have actually risen. Some of you have seen that slide. You're familiar with that slide. There were 2 times in this country where homes lost value during recessions. One time was 2008, which is a historic time where homes lost almost 20% value. The other time, the early 90s, where marginal loss, I believe, under 2%. But I'll bring that in the future. It's a great question. But 4 out of the last 6 recessions, home values have improved.
Awesome. Thank you for that, Dave. And I just saw one more come in from Drew, who asked, David, do you think there will be a wave of new financial products for consumers given the increase in rates and decrease in loan origination?
Sure. Yeah, I've got a lot of questions on that. Listen, I think here in this country and in the financial system, we're all about innovation. And so that's why I said I think you'll see more arms come back into the market and people are managing debt. I certainly hope we don't see products come back in that are misused or unwise, but I think you will see innovation in that to help people more affordably buy homes, whatever that may be, the length of the mortgage, the type of mortgage, the way it's structured, things like that, certainly. Yeah, I see a question in here, a 40-year mortgage. That's come up a lot. I haven't heard anything specific on that, but that's certainly something that's discussed.
All right, awesome. That was the last question that I saw come through, Dave.
All right, good. Thanks, Jess. Well, listen, we'll wrap up on that. This is a big question. Use these slides, use all this information. If you're not a KCM member, go ahead and start a free trial. You're going to want to get this information as we go through the next few months. A lot of people will be talking about this throughout the spring market and into the summer, and certainly the recession talk coming up. A lot of people talking about that. We'll keep you covered on that. Have a great week. Thanks for joining the deep dive, and we'll see you back next week. Take care.